Hi, welcome to Know It Olly ELI5's Spoofing. So spoofing is a method used in the markets to manipulate the price. If you want the price to go up or down so that you can get the price you want for a share, whether that's the buy or the sell, spoofing is a method that has been used for a very long time within the markets. The way you do it is you make an order that you have no intent on filling, but people can see the order, think it's a real order, react as though it's a real order, but they will pull that order from the market right before it gets filled. So what that does is if you want to buy a stock, but you don't want to buy it for $110, you want to buy it for $100. So what you would do is you would go to the sell side, you would put in your buy order at $100. And then on the sell side, where it's at $110, you would start putting in fake orders down to and below $100. That way everyone thinks someone's just come into the market and is selling everything that they can. They give a false view of the amount of money and liquidity running through that particular security at that point of time. They do this by layering, so they'll have false orders at 110, 19, 18, 17, 16, all the way down to where they want to get the price. As the price, say, drops towards that $100, they go through those layers, they delete those orders right as they go through. But because everyone else can't see what's going on, they're making trades at those new prices that are being spoofed into the system. That way, they will drive the price down to that $100 where they'll hit their actual order that will actually execute. So the idea behind spoofing is that you'll put through 100, 200, 1,000 apparent orders into the book, but you only have 10 orders that you actually plan on filling. And they do this by both the layering and with algorithms, so that it is incredibly high-speed trading with these orders being put in and removed in split seconds at times, so that the books see that something's happening and it changes the price accordingly, but in actual fact you're spoofing the computers and causing people harm and distress within the markets by falsifying what the prices are. There was actually an event of a guy in England who lived in his parents' house. He was incredibly smart and wrote a number of programs to do this exact form of layering and spoofing. He caused what is called a flash crash, which is when a price just gets absolutely hammered down to 70, 80, 90% below what it's supposed to, and then it pops straight back up because you're using spoofing to move the price. He got in quite a bit of trouble for it. They've put a lot of processes into place in the markets to try and avoid this from happening. However, it's still possible. See my notes or my video on trading to 4 decimal places. Retail can only trade to 1 cent. However, hedge funds, market makers, and big industry can trade to 4 decimal places, which means that they can hide orders in between retail ones to push the price around. So this is actually a pretty major issue within the market that people need to be aware of. So I hope that explained it nicely. Know It Olly out.